More not so good news for the housing market. The latest existing home sales went down 5.9% in July. I think at this point, it's safe to say we are not in the beginning of a downward trend, but in a downward trend already. If you follow the channel, you know I have been bullish about this housing market since last year and still the beginning of this year. Now, not so much. I think the writing is clearly on the wall that real estate prices are going to go down year over year when we compare 2023 to 2022. The question is, by how much? Let me give you the latest report from the National Association of Realtors Existing Home Sales Report. Let's look at the regional data first. Existing home sales in the Northwest went down by 7.5% from June to July and down 16.2% from July of 2021. The median price in the Northeast was $444,000, which is 8.1% up from the previous year. Existing home sales in the Midwest declined 3.3% from the prior month and dropping 14.4% from July of 2021. The median price, $293,000, up 7%. Existing home sales in the South is down 5.3% in July and down 19.6% from 1 year ago. The median price in the South was $365,000, an increase of 14.7%. Existing home sales in the West declined 9.4% compared to last month and down 30.4% from this time last year. The median price in the West was $614,900, an 8.1% jump from July of 2021. According to Lawrence Yun, the action is in the pricey West region, which experienced the sharpest sales decline combined with sizable inventory increases. It's likely some Western markets will see price decline, and that will be welcome news for buyers who watch rapid price jumps during the past 2 years. Overall, existing home sales is down for the 6th straight month in July, and as you can see, all 4 major U.S. regions recorded month-over-month and year-over-year sales declines. Nationally, the sales number looks like this. Total existing home sales for all types of properties is down 5.9% from June to July. Year-over-year sales fell 20.2%. The sales decline or ongoing sales decline is a direct impact of mortgage rates increasing, especially in early June when it was over 6%. The good news is that rates are starting to stabilize in the 5% range, and I believe that if we go back down below 5%, this will bring out more buyers that were priced out or maybe just didn't really want to buy when rates were in the high 5s and over 6%. Also, because of this slowdown in buyer demand, inventory is starting to climb. Total housing inventory at the end of July increased 4.8% from June, but the same from the previous year. Unsold inventory is at 3.3 months supply at the current sales pace, up from 2.9 months in June and 2.6 months in July of 2021. Home prices is just so resilient. The median existing home price for all existing home types in July was $403,800. This is up a healthy 10.8% from July of 2021. As I have mentioned on the regional breakdown, prices increase in all regions. This marks 125 consecutive months of year-over-year price increases, the longest running streak on record. I am now 0 for 2. The last 2 months I have said that we should see this streak end, but it continues to go up. I'm doubling down. For August, this year-over-year increase will go down. Well, I don't really know that for a fact, but at this point, who knows what happens. According to our favorite economist, Lawrence Yun, we're witnessing a housing recession in terms of declining home sales and home building. However, it's not a recession in home prices. Inventory remains tight and prices continue to rise nationally, with nearly 40% of homes still commanding the full list price. I don't know if I need to add anything to that, but that really sums up not only the local market here in the East Bay or the Bay Area, but really the national market. Days on the market changed slightly. Properties typically remained on the market for 14 days in July, the same as in June, and down from 17 days in July of 2021. So we are selling faster this July compared to July of 2021. The 14 days on the market are the fewest since I began tracking it in May of 2011. 82% of homes sold in July 2022 were on the market for less than a month. Here's the breakdown by property types. Single-family home sales declined by 5.5% from June to July and down 19% from 1 year ago. The median existing single-family home price was $410,000 in July, up 10.6% from July of 2021. Existing condos and co-op sales were down 9.1% from June to July and down 29.6% from 1 year ago. The median existing condo price was $345,000 in July, an annual increase of 9.9%. In the world of new homes or new construction, things are not good either. Home sales are down 12.6% in July. This is a big miss, and it's the sixth time this year we've had consecutive declines and also the slowest pace since 2016. So we have existing home sales plummeting, construction of new homes slowing down, cancellations are going up, applications for mortgages are also plummeting, and price reductions are also increasing. Doesn't take a genius to see what could be next. And as a result of all these, we are starting to see more inventory. We are still in a flux right now with regards to inventory. What I mean by this is that demand and supply are still not in equilibrium. A big part of the reason that inventory is climbing is because it has become unaffordable at these prices and at these mortgage rates, which is really not what you want to see. What we want to see is more actual inventory so that housing can become more affordable. And I will keep saying this, and some might not agree with me. We still have buyer demand that needs to be met. What is happening right now in the market is not really the solution. Several things happens in this scenario, all of which is again not the ideal solution. Number one, if it's too expensive to buy a home for everyone, renters will just continue to rent. Number two, if more people continue to rent, guess what happens with rent prices? It goes up, and we are already seeing this across the country in all major metro areas. Number three, more sellers, if they can't get the price that they want for their property, they will pull their properties off the market and just consider renting it out. Less inventory again. I just had this happen with one transaction. The seller could not get the price that they want, and they decided to rent the property because renting the home was very profitable because of increasing rents. For you renters out there, hear this. Buying a home may make more financial sense than renting even at these levels, and here's why. It's not just home prices that have risen in recent years, like I said. Rental prices have skyrocketed as well. As a recent article from realtor.com says, the median rent across the 50 largest U.S. metropolitan areas reached $1,876 in June, a new record level for realtor.com data for the 16th consecutive month. That means rising prices will likely impact your housing plans either way. But there are a few key differences that would make buying a home a more worthwhile option for you. If you need more space, buying a home may be more affordable. What you may not realize is that according to the latest data from realtor.com and the National Association of Realtors, it may actually be more affordable to buy than rent depending on how many bedrooms you need. Take a look at this graph. As the graph conveys, if you need 2 or more bedrooms, it may actually be more affordable to buy a home even as prices rise. While this doesn't take into consideration the interest rate deduction or other financial advantages that come with owning a home, it does help paint a picture that it may be more affordable to buy than rent for that unit size based on nationwide averages. So, if one of the factors motivating you to move is the desire for more space, this could be added encouragement for you if you need to consider home ownership. Home ownership also provides stability and a chance to grow your wealth. In addition to being more affordable, depending on how many bedrooms you need, buying has 2 other key benefits: payment stability and equity. When you buy a home, you lock in your monthly payment with your fixed rate mortgage, and that's especially important in today's inflationary economy. With inflation, prices rise across the board for things like gas, groceries, and more. Locking in your housing payment, which is likely your largest monthly expense, can provide greater long-term stability and help shield you from those rising expenses moving forward. Renting doesn't provide that same stability or predictability. A recent article from CNET explains it like this. If you buy a house and secure a fixed rate mortgage, that means that no matter how much prices or interest rates go up, your fixed payment will stay the same every month. That's an advantage over renting since there's a good chance your landlord will raise your rent to counter inflationary pressures. Not to mention, when you buy, you have the chance to build equity, which in turn grows your net worth. It works like this. As you pay down your home loan over time and as home values continue to appreciate, so does your equity. And that equity can make it easier to fuel a move in the future to a home that's probably much bigger if you so desire. So think about that if you're a renter or considering buying. This is an opportunity right now that might not last a long time. Now, even though there are expectations of prices going down in 2023 and or 2024, no one is actually saying or expecting 2008 to happen all over again. No foreclosure crisis, no 30 to 50% decline. Primarily because homeowners have a ton of equity and the quality of buyers lately are so high. Lending standards are so stringent nowadays. We could see a housing crash only if our economy goes into a tailspin, meaning massive unemployment. So you might now be wondering, why then are we still in danger of seeing 10 or maybe 20% decline in the market? Well, it all comes down to need. There are and always will be sellers that will need to sell no matter what, given their situation. And with buyer demand being down because of affordability, pricing will become a factor. In other words, pricing pressure on the downside. This is particularly true if rates stays in the upper 5% or God forbid, we are back in the 6s. So now, what do you do if you're a seller? Well, I'm glad you asked. If you're asking yourself if you missed your chance to sell your house and make a move, the good news is that you haven't yet. Motivated buyers are still out there, but you do need to price your house right for today's market. Here's why. Homes that are priced right with regards to condition, competition, neighborhood are still selling very quickly. Conversely, homes priced too high are staying on the market and having price reductions. It's true, buyer demand has slowed over the past few months as higher mortgage rates made it more expensive to buy a home. The result is fewer bidding wars and less competition among buyers. But don't forget, that's compared to the severely overheated market we saw over the past 2 years. In other words, not a normal market. According to the latest confidence index from NAR, 39% of homes sold above list price, down from 51% a month ago and 50% a year ago. While this is a slower pace than even 1 month ago, serious buyers are still actively in the market and they're buying homes that are priced right. In fact, the average home is selling in just under 14 days. If you're aiming to sell your house, be sure you're working to price it right for today's housing market. As buyer demand softens, it's important to understand this isn't the same market as last year. It's not even the same market just a few months ago, but it's still a seller's market. Look, everybody is anticipating not only a slowdown, but also price reductions. So get your pricing right the first time so that your house won't stay on the market for a long time. Bottom line, whether you are a home buyer or a home seller, while the housing market has cooled off from its overheated frenzy, it's still a seller's market, but a fragile seller's market at that. For buyers, grab the opportunity while there's very little competition. This is especially true to home buyers here in the Bay Area that don't have a lot of down payment or are using loans like FHA or VA or down payment assistance type. This window of opportunity might be slim. Grab it while you still can. Hey, thanks for watching. I'll see you on my next video. Have a great day.